Now, let's get on to the Fed and the rate cut and mortgages, because many people thought, hey, the Fed's cutting rates, so mortgages should be going down. But is that actually what happens out there? As we all know, the Fed's lowered the rate by 25 basis points, so the new Fed rate is between 4 and 4.25. But how is that affecting the mortgage rates? Well, actually, there was a little bit of overexuberance where many of the companies out there actually started lowering rates a little bit ahead of the Fed cut. You know, whether they were trying to drive additional sales or whether they were just thinking it was going to go down, I think they know better. So it's probably trying to drive sales for the mortgages. But at the end of the day, the Fed rate cut didn't lower the rate like everybody thought it was going to. And one of the reasons is we have stronger than expected economic data. And probably more importantly, is the 10-year Treasury yield is going up. And the one thing most people don't understand, and we haven't really heard it too much in the news, is that the mortgage rates are actually driven more by the 10-year Treasury yield than the Fed's. And this chart kind of shows what happened this week. You know, the Fed rate cut was done on the 17th, and the Treasury yields actually went up. And if you've been following the mortgage rates, you'll see after that date, the mortgage rates started to go up as well. It's kind of interesting, but it's not playing out the way everybody thought it was going to.